Welcome back to Tip Tuesday, everyone. And today we have been getting an increase in the amount of questions regarding assumable mortgages. And Ryan, we talked about assumable mortgages last year. And today, what we want to dive into is a little bit more detail on how an assumable mortgage can really benefit our customers. So I'm going to let you take it away, sir.
Yeah, I'm so glad we're bringing this up again because we are getting a lot of questions on it. That there's more and more news articles that are coming out, and a lot of our new buyers are asking questions. And really, with interest rates still above average, there's more and more talk about these assumable mortgages. That's why, it really hasn't gone away. And what it is, just kind of a reminder, it's when a buyer purchases a home from a seller and the current loan on the home is being transferred to the new buyer. So a new mortgage isn't started. The current one is just transferred. This has become more and more popular over the past 12 months, obviously, because rates were so low between 2020 and 2022. So if someone who wants to sell their home got financing during that very low rate period, a new buyer could come along and take over that mortgage, which is possibly in the 2% or 3% range. Now, a few things to be aware of. Not all mortgages are assumable. For example, conventional financing is rarely assumable, unfortunately, and those do make up about, from what I read, 44% of active mortgages out there. But government insured loans, which I know we've talked about a lot, FHA, VA, USDA, can be assumable. So to qualify for the current loan being transferred, you still do have to get approved for a loan, like you would with us getting pre-approved for a brand new mortgage. And the current bank does need to approve the assumption. But one of the biggest things that I wanted to make sure to bring up that prevents these mortgages and the assumptions is you have to come in with a large down payment. So I wanted to kind of go over an example. So let's say you purchase a home for $400,000 and you get approved to assume the current mortgage that's $300,000. And it's got a great rate, 2.875. That's fantastic compared to where we're at right now in the sixes and sevens. So you are going to be short $100,000 to get to that $400,000 purchase price because it's only $300,000 that you're assuming. So, we do have options because you do have to bring in that difference. And you could do it in a few ways. You could just bring cash. You could just bring the $100,000 to make up the difference, assume that mortgage, and you're good. Close on the house, you got a great rate. But, a lot of our buyers, they don't really have that much sitting around. So, what we could do, another option is getting a second mortgage. Now, we could go into more detail about this because it's going to be like a whole nother Tip Tuesday.
And
But
we
for
will.
now, just know second mortgages are available to kind of help cover this difference between the assumable mortgage and the purchase price. So it's a great option to consider. And it's a big thing that's holding people back. And it's really something that could kind of, make up the gap between those two numbers. So we could talk about that next week.
Yeah, so stay tuned for part two, where we'll go over how to take on a second mortgage to make up the difference from an assumable mortgage. So awesome, Ryan. Thank you as always. We will see you guys next week.
Bye, everyone.